hand. They didn't care about the quality of the mortgage. They were caring about maximizing the volume and getting a fee out of it.
In the early 2000s, there was a huge increase in the riskiest loans, called subprime. But when thousands of subprime loans were combined to create CDOs, many of them still received AAA ratings.
Now, it would have been possible to create derivative products that don't have these risks, that carry the equivalent of deductibles, where there are limits on the risks that can be taken on and so forth. They didn't do that, did they?
They didn't do that, and in retrospect, they should have done.
So did these guys know that they were doing something dangerous?
I think they did.
All the incentives that the financial institutions offered to their mortgage brokers were based on selling the most profitable products, which were predatory loans.
If the banker makes more money if they put you in a subprime loan, that's where they're gonna put you.
Suddenly, hundreds of billions of dollars a year were flowing through the securitization chain. Since anyone could get a mortgage, home purchases and housing prices skyrocketed. The result was the biggest financial bubble in history.
Real estate is real. They can see their asset. They can live in their asset. They can rent out their asset.
You had a huge boom in housing that made no sense at all. The financing appetites of the financial sector drove what everybody else did.
Last time we had a housing bubble was in the late 80s. In that case, the increase in home prices had been relatively minor. That housing bubble led to a relatively severe recession. From 1996 until 2006, real home prices effectively doubled.
At $500 a ticket, they've come to hear how to buy their very own piece of the American dream.
Goldman Sachs, Bear Stearns, Lehman Brothers, Merrill Lynch were all in on this. The subprime lending alone increased from $30 billion a year in funding to over $600 billion a year in 10 years. They knew what was happening.
Countrywide Financial, the largest subprime lender, issued $97 billion worth of loans. It made over $11 billion in profits as a result. On Wall Street, annual cash bonuses spiked. Traders and CEOs became enormously wealthy during the bubble. Lehman Brothers was a top underwriter of subprime lending, and their CEO, Richard Fuld, took home $485 million.
On Wall Street, this housing and credit bubble was leading to hundreds of billions of dollars of profits. By 2006, about 40% of all profits of S&P 500 firms was coming from financial institutions.
It wasn't real profits, it wasn't real income, it was just money that was being created by the system and booked as income 2-3 years down the road. There's a default, it's all wiped out. I think it was, in fact, in retrospect, a great big national, and not just national, global Ponzi scheme.
Through the Home Ownership and Equity Protection Act, the Federal Reserve Board had broad authority to regulate the mortgage industry, but Fed Chairman Alan Greenspan refused to use it.
Alan Greenspan said, no, that's regulation. Ideologically, I don't believe in it.
For 20 years, Robert Gnizda was the head of Greenlining, a powerful consumer advocacy group. He met with Greenspan on a regular basis.
We gave him an example of Countrywide and 150 different complex adjustable rate mortgages. He said, if you had a doctorate in math, you wouldn't be able to understand them enough to know which was good for you and which wasn't. So we thought he was going to take action. But as the conversation continued, it was clear he was stuck with his ideology. We met again with Greenspan in '05. Often we met with him twice a year, and never less than once a year. and he wouldn't change his mind.
In this amazing world of instant global communications, the free and efficient movement of capital is helping to create the greatest prosperity in human history.
$146 people were cut from the enforcement division of the SEC. Is that what you also testified to?
Yes. Yeah, I think there has been a systematic gutting, or whatever you want to call it, of the agency and its capability through cutting back a staff.
The SEC Office of Risk Management was reduced to a staff, did you say, of one?
Yeah, when that gentleman would go home at night, he could turn the lights out.
During the bubble, the investment banks were borrowing heavily to buy more loans and create more CDOs. The ratio between borrowed money and the bank's own money was called leverage. The more the banks borrowed, the higher their leverage. In 2004, Henry Paulson, the CEO of Goldman Sachs, helped lobby the Securities and Exchange Commission to relax limits on leverage, allowing the banks to sharply increase their borrowing.
The SEC somehow decided to let investment banks gamble a lot more. That was nuts. I don't know why they did that, but they did that.
We've said these are the big guys, and clearly that's true. But that means if anything goes wrong, it's going to be an awfully big mess.
At these levels, you obviously are dealing with the most highly sophisticated financial institutions.
These are the firms that do most of the derivative activity in the United States. We talked to some of them as to what their comfort level was.
The firms actually thought that the number was appropriate.
The commissioners vote to adopt the rule amendments and new rules as recommended by the staff.
Yes, Judge.
Yes.
We do indeed. Unanimous, and we are adjourned.
The degree of leverage in the financial system became absolutely frightening. Investment banks leveraging up to the level of, 33 to 1, which means that a tiny 3% decrease in the value of their asset base would leave them insolvent.
There was another ticking time bomb in the financial system. AIG, the world's largest insurance company, was selling huge quantities of derivatives called credit default swaps. For investors who owned CDOs, credit default swaps worked like an insurance policy. An investor who purchased a credit default swap paid AIG a quarterly premium. If the CDO went bad, AIG promised to pay the investor for their losses. But unlike regular insurance, speculators could also buy credit default swaps from AIG in order to bet against CDOs they didn't own.
In insurance, you can only insure something you own. Let's say you and I own property. I own a house. I can only insure that house once. The derivatives universe essentially enables anybody to actually insure that house. So you could insure that, somebody else could do that, so 50 people might insure my house. So what happens is, if my house burns down, now the number of losses in the system becomes proportionately larger.
Since credit default swaps were unregulated, AIG didn't have to put aside any money to cover potential losses. Instead, AIG paid its employees huge cash bonuses as soon as contracts were signed. But if the CDOs later went bad, AIG would be on the hook.
People are essentially being rewarded for taking massive risks in good times that generate short-term revenues and profits and therefore bonuses, but that's going to lead to the firm to be bankrupt over time. That's a totally distorted system of compensation.
AIG's financial products division in London issued $500 billion worth of credit default swaps during the bubble, many of them for CDOs backed by subprime mortgages. The 400 employees at AIG FP made $3.5 billion between 2000 and 2007. Joseph Cassano, the head of AIG FP, personally made $315 million.